now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. This interview is sponsored by Power Metal Resources. Be sure to click the link in the description below to check out their company so that you can take advantage of the uranium and gold bull market as well as the many other commodities that they focus on. This message is also sponsored by the Rural Symposium. Be sure to click the link in the description below to check out the event. I'm going to be there this year. You will meet others who have been on the channel, such as the legendary investor Rick Rule himself. So be sure to click that link in the description below so that you can get access to this event, whether you attend virtual or in person. All right, let's get to the interview. Hey, Chris, glad to have you back on the show.
Hey, always a pleasure, Daryl. Thanks for having me.
Yes, indeed. A lot to cover since the last time you came on. I'm going to go ahead and share screen really quick. There was this article that came out by Financial Times, and this article has to do with gold. So it says gold stockpiling in New York leads to London shortage. And so in this article, it talks about how people are afraid of what the tariffs are going to do, and if the tariffs are going to have some form of impact on gold or whatnot. And they're saying that there was traders amassed in 82 billion stockpile in New York, and pretty much the Bank of England is having trouble delivering all of this gold to New York that people are buying, and ultimately they are afraid of what the tariffs are going to do. And I know that you're in Canada and such, and so just want to get your assessment of this, and then just your assessment of gold in general.
Yeah, I think it's really interesting seeing all the gold move, from the UK over to United States. It always is a worry what's coming down the line. What do they have planned? So that is a little bit of a concern, and probably won't see much happen with gold. I think we're starting to see gold break out and push up because people are nervous. They're like, okay, something's going on in the gold space. America's taking it all back. They want to have it in their physical hands. So that's probably why we're seeing one of the reasons gold is moving and starting to run to some new all-time highs. But we're in that market environment where gold should do really well and keep doing well for another month or two, even if the stock market struggles here. So I think it's interesting. I like the precious metal space, and I think it's going to go to about 3,050 is the next upside target now that it's broken out. So it's got some pretty good potential to continue to run. In terms of the tariffs, I don't know how that's going to affect things. I mean, I've heard a couple totally different stories. I heard that Canada really, there's a very interesting short that they're wanting the tariffs to come. And there's this huge scenario that somebody's planned out that it's going to work out well for Canada. It's going to create more liquidity. It's going to work that people in Canada have to get more debt. And anyway, it's brutal. It's a super negative spin on what the new prime minister is probably going to implement and how they've been positioned with buying $1 billion worth of real estate in the United States. And they want the crash. They want all this, and they're going to benefit and rent all these properties out. It's such a dirty, I mean, I hate politics, and they're such long-term planners, and they're out to kill, it seems. But this is going to be a wild year, I think, for almost all asset classes, businesses, entrepreneurs, individuals. I think things are going to be having some wild swings. And obviously, AI is just sweeping in and changing so dramatically. Now you can run AI on your own personal PC with the way DeepSeek is doing it, where it requires very little processing power. You get like 90 to 95% of the accuracy and speed of open AI. And you can do it with it's just crazy. World is changing very quickly.
Yeah. I want to get back to DeepSeek's impact on the markets recently a little bit in a little bit. But could you show us the chart of gold and just kind of what you're looking at? What's giving you? What's the reasoning behind the $33,050 target?
Yeah, if we take a look at gold's been obviously in this series of more or less rally, pause, rally, pause, rally, pause, and now it's breaking out to the upside. Overall, just based on the chart pattern, is pointing to, if I squish the chart down, it looks like gold should run to about 30.50. So percentage wise, it's actually a pretty nice run for gold from where it is right now. That's another 6% move to the upside. And I think this is telling us that there's a lot more fear going on in the markets. When we look at the monthly chart of gold, this
Are
is,
you doing
this
are
is
you
what
doing
we,
that based on Fibonacci?
yeah, based
Yeah,
on
okay.
Fibonacci, when we go back and take a look at the last time we saw gold run up and do this type of move, I believe this is going to be like a blow off move where gold surges up. There's all kinds of chaos, uncertainty. And I feel like the stock market and everything is about to come tumbling down. And then it's going to reverse and have a big pullback and another pause, or potentially a much deeper pullback to the 22,000 level. Because I believe we're going to go into a recession type of thing like we saw in 2007, 2008, as it pulled back. So really, when we look at gold, the long-term Fibonacci targets have been hit. When we look at where it was to the big rally in 2011 and the pullback, we came and we hit this level. We've had a pullback, and now it's running up to this next level up here. And so you got to be bullish. I like physical gold. I hold gold. I am waiting for a bigger reset to buy another batch of gold once it does have some type of big pause and pullback. So until then, we're just got to let it do its thing. People are piling in, and I believe we're very close to a top in gold. But the move is telling us there is global fear, and the money shifting to America, to me, is a huge red flag that something bad's about to happen.
Yeah, yeah. So what, how much of a percentage drop is that if it goes up to 30, 50, and then let's say it does retrace to 2200? What
Yeah,
percentage drop is
it'll
that?
be somewhere around a 20, I mean, yeah, like a 25, 20, 30% pullback, 34%, which, believe it or not, is exactly what it pulled back in 2008. Uh, and if you take a look, we zoom in, you come back to this breakout level where it had this bull flag pattern. That's also right where it pulled back to before, and that's this level across here. So this is like the worry phase, everybody piling in, and then there's a financial reset unwinding event. It could test this level, and then from there is when I think we see gold like skyrocket up into probably like the 5,000 range, and it would last several years. I think it'll be a big move. It'll be the next major run, and that's when like gold miners and silver miners are going to become like super powerful. They'll be the favored play. Gold will be the slow one. You don't really want gold at that point. You want the gold miners, because that's where you can
Hmm.
make hundreds, potentially thousands of percent return on some of these gold miners. And if the market does pull back and unwind, the gold miners will be dirt cheap, below value, and lots of upside potential from both a technical and a fundamental standpoint.
Okay, so in 2011, we see gold peak. Where how much of a percentage drop was it from that peak to I think it was what, 2013?
Yeah, 2015,
No,
the whole
2015.
drop was about 45%. So it doesn't look like much when you're looking at something that keeps wanting to go up, but that is a huge haircut. This move up here was a super cycle to the upside. This was a super cycle to the downside. We're really actually just starting a new super cycle. This is kind of it to the upside uh, from this 2019 breakout. But yeah, gold has a lot of volatility. This is why there aren't many safe havens when the markets fall apart. If you hold on to assets, they're probably going to go down. There's a time when you need to like move to a different asset. Could be a currency, could be bonds. I think bonds will be a good play, but you can't, unless you want to go through these roller coaster rides and wait literally like 9 years to start hitting some new highs, and wait like 13, 14 years to make real money again if you bought at the peak. That's a lot of wasted time. People don't realize like there's all kinds of other trades you can do. So many people get stuck in one sector and all they do is watch like precious metals and
Hmm.
miners, and they don't go outside of the bubble. And once something's topped, you do have to go find something else until it's set up another pattern. And then you can get back into the precious metal space. 2019 was the turnaround where it put in a bottom, broke into a new super cycle, and now it's starting this whole phase. This whole move here, like if we were to squish this down, is let me just go back. We could see gold go up to like 4,000, 5,000. That'll be similar to the type of move that we saw back over here, where it started the super cycle last time, where it had this big move. So we're we're in this hiccup phase right here in terms of we need some financial reset. and price is going to chop around, and then from there, have that next multi-year run to the upside. That's what I'm hoping for. That's what I'm expecting. But
Hmm.
right now, gold is in an uptrend. It's muscling higher. You definitely don't want to bet against it.
Yeah, yeah, yeah. So, as we see, like in obviously the blow off top in 2011, and then you also had the move up in 2009. At that time, the Fed started quantitative easing, and pretty much the dollar was pushed down significantly over that time. And so, I'm kind of wondering what is the dollar, what's the dollars going to look like in this type of environment, especially with gold rallying. Usually, when the dollar falls, gold rallies, and vice versa. But we've had gold staying elevated even with the dollars move up recently, and so I just want to see what you think about the dollar.
Yeah, I think the dollar's put in a major bottom back in 2005 to 2015. It's now in a series of like rally, pause, rally, pause. We are seeing a series of higher lows. We're seeing a series of higher highs. I do think we're going to see the dollar really, believe it or not, take off. I know Trump doesn't want a high dollar; he wants a falling dollar and lower interest rates. But I think there's only so much. The market, has a lot more control than the Fed. I think the Fed's starting to lose a little bit of control of the interest rates and what's going on. And I think we're going to see the dollar continue to move up as kind of uncertainty and chaos hits. We saw during the 2000 tech bubble, we saw the US dollar have this huge move up with fear and uncertainty. In 2008, when the stock market crashed, we saw the US dollar rally 26%. I think we're going to see it go back up into the 20s, mid 20s or higher, which is about an 18% upside move from where it is right now. So I think there's a lot of upside, and that will also add a lot of pressure to commodities and gold once this takes off. But we have been seeing people moving into both. The dollar's been moving up, gold's been moving up. That to me is a huge red flag that people are like liquidating. They're worried about, you know, um, equities and home pricing. And they're both the dollar's going up and gold. That to me is like the ultimate kind of warning something bad is likely about to happen.
Yeah, I just finished the book, The Psychology of Money, and he was referring to how much cash him and he has, and everything, and he talks about like just having that much cash gives you the ability to take advantage, if there's a huge market downturn,
Yeah.
and so just looking at these cycles and the dollar and seeing how it rallies, I'm kind of wondering what would the Fed do in this situation? I mean, they've paused on they've said they've paused on rate cuts.
Yeah.
They're still quantitative tightening. They haven't started adding to their balance sheet yet, but I know that if there's another significant, crisis like the pandemic or the 2008, they're likely going to start buying government debt again. And I don't know if they're going to buy the long end and do some yield curve control or what, but it seems like they may be building their balance sheet again at some point.
Yeah. I think when things start to fall apart, I always think of like the economy and the world is like a giant game of Monopoly. And it's like instead of letting the game take its course and have winners and losers and financial resets and all that stuff, it's like everybody just cheats and they're like, no, let's keep the game going. I'll give you some more money and let's make a new rule to do this. And so it's just a bunch of cheaters, right? All keeping the game going because nobody wants it to end and nobody wants to be a loser. And I think the Fed will do whatever they have to when the time comes. I think eventually they'll cut rates and they'll probably do more money out and more QE, of some sort, and they'll start adding to their balance sheet to buy up equities and buy up debt and try to support everything. I mean, they just don't want to lose. So when the time comes, I think we'll see that. But once you go into a big bear market phase and everybody's selling off, like where we see a stage 4 decline, which you and I have kind of talked about before, which is a huge reset. And this is like usually a global reset. All stock markets are going down. Everybody's worried. Investors and businesses are going under. When we're in this phase, doesn't matter what they do. Like they cut rates, they start trying to buy things and support the markets, but you can't stop a global tidal wave of people nervous and selling. And when they're in difficult times, people have to sell a lot of their equities investments to subsidize their businesses or subsidize their life because they've lost jobs or their businesses aren't doing well. So I think eventually the Fed's going to have to start cutting rates, and they're going to do everything they've already done in the past. Just another set of QE, some new kind of game that they're going to play and try to support the markets. But I do think the markets are going to get hit. They're not going to be able to support it, just like in the tech bubble in 2008. Once that tide starts going down and the whole world's selling, they're going to try, but it's not going to work. Markets are still going to have a financial reset. You can't stop, a tsunami coming.
Yeah, definitely. I mean, I think that's going to be a big black eye for Trump. But I mean, obviously, I think he gonna find somebody to blame, whether he blames the Biden administration. Which I know there's some Trump fans out there, and the whole thing about inflation is like, yeah, you started it, with the money printing and signing their checks and everything, and then obviously it comes at a lag, and maybe Biden did some things that in within his term that comes with a lag in Trump's term. So,
Yeah.
but at the same time, you can't blame what happened in the prior administration,
Yeah.
for what's happening. And so I think Harry Truman said everything that happens starts at the desk here, and so it's kind of interesting. So that's going to be pretty interesting if that plays out. But
Yeah, I mean, it doesn't matter what president gets in there. They're all getting dropped into a rat's nest of a nightmare. Like,
yeah,
some of them just get a worse setup than the other, but it doesn't matter what president's there. I think they're all dealt a bad hand because
yeah,
they're literally just getting dealt a bad hand every time. It's like who can try to make the best of it, and where we are in economic cycles and human sentiment and what's going on in businesses, it just makes it always unique. But you can't always just blame it on a president. They're all just stuck with a ton of
yeah.
nightmares that the other person did and the person before them, and it snowballs, right?
Yeah. No, nobody. I mean, and if you're in that type of position, I imagine you don't want to be looked at in a certain way. You may feel you have
For
a
sure.
legacy or
Yeah.
something. So
Yeah.
yeah, it's kind of those interesting dynamics. Transitioning to DeepSeek and along the line of market bubble. There's been I read a couple of articles about DeepSeek coming out, and they related it to the Sputnik in the race between Russia and the United States, the space race. And they're saying like, okay, China's coming out and saying like, hey, Trump came out and said United States should be number one in AI. We're going to be number one in crypto and things of that nature. And now China's launched a product, and this product had a big implication for the markets. Nvidia declined about 16% or something of that nature.
Yeah.
The uranium stocks sold off and everything. And so it's like, okay, are we in like bubble territory where we can get one headline and that just impacts so much of the markets? And so I wanted to get your assessment of that.
Yeah, I think the market is very sensitive. Like the big drop that we saw around DeepSeek, a lot of people were thinking the market was topping. Really, it was a news driven move. It happened to be in the one sector that is like the heavyweight of the stock market. So it hit the stock market hard and everybody was panicking, but really there were other sectors doing very well. In fact, the most conservative assets were doing exceptionally well. We saw real estate up the most, financials were up, we saw healthcare, we saw consumer staples. So people were just moving out of the AI space. And because it's so mainstream, everybody's in Nvidia, everybody's into all the crypto and all that stuff. All the aggressive people are into those plays, trying to get maximum growth. And so, and as you just said, America wants to be like the leader in AI and all that stuff. And the fact that somebody came out with an AI that is run way easier or cheaper, with requiring a lot less power, and it's from China. I think the fact that it's China's is probably the biggest scare, right? It's not, because if it wasn't from China, it would just be like, oh, there's a new competitor with a really efficient AI, but it's like, oh, there's the competitor who's from China, which, everybody's paranoid about China. So that to me was the scary word. As soon as they saw it was from China, it's not now a competitor, it's like a threat. Um, so that's where I think the big move was. And because everybody's piled into NVIDIA, they very quickly moving out. They're, emotions, people fearful. I think the DeepSeek has probably put a little bit of a cap in the AI space, in the semiconductor space, because now it's like, OpenAI has been around for like 10 years or so. They have 4,500 employees. They spent $100 million training OpenAI, and that requires crazy processing power. And then DeepSeek comes out, and they're like, "Oh, in 2 years, with 200 people and $5 million to train it, we can run it on a normal PC, more or less a gaming PC, and we're good to go." And you get almost the same accuracy because they don't go as many decimal points for accuracy. OpenAI goes like 32 decimal points back. DeepSeek goes only 8, but they say you get 90 to 90% of the same speed in processing power and accuracy. So it's a game changer. And I think that has put the brakes on NVIDIA and semiconductors. And it's now broadened up the AI space because now it makes it affordable for people to run their own and modify. It's all open source and free, the DeepSeek. So it's a game changer for the AI. It's definitely, I think, put some serious damage into NVIDIA.
Yeah, for sure. So, speaking of China and other markets outside of the U.S., I know a lot of capital, a lot of money is piled into U.S. markets, and if you are projecting, let's say the dollar's going to go a lot higher, that usually means that other markets who have their debt priced in dollars fall. So we would see what the Chinese markets fall against the dollar, as well as, I mean, Argentina's been running strong as well. And so, what's your take on the dollar, U.S. stocks, and emerging market stocks?
Well, yeah, if you were to compare like all the major indexes of around the world, so the German DAX, and you go look at the UK, the London exchanges, you put all the stock markets together and you overlay them and you zoom out, you'll realize they all move together. When there's a bull market in the US, there's a bull market pretty much in the other countries. When there's a bear market in the US, all the other country stocks are going down. They pretty much all move together. And this is why, like the whole strategy you and I have talked about, which is my asset revesting strategy, it's like there's a time to own equities, stocks in general, and there's a time not to own them and go own something else. And so that's what people don't understand. People like to diversify. They're like, "Oh, I'm going to own small caps, and I'm going to own some tech, and I'm going to own some biotech, and I'm going to own some German stocks and all that stuff." And they don't realize they're all the same trade. When the market crashes, they all go down. Even dividend stocks, there's no real protection there, right? So I think if you can understand which way the US markets are going, I use the SP 500 as the main barometer for pretty much the whole world of equities. If you can track the SP 500, whether you're a day trader, swing trader, or like investor trends, you know whether to be long or short. And, if we look at the long term, like weekly chart of the SP 500, there's times after COVID when we're in a bullish phase. There's times in 2022 we're in a bearish phase. You shouldn't hold equities, and we're still in this bull market. And this drop that happened last week with the DeepSeek, if we were to zoom in on the weekly chart, in the grand scheme of things, all it was this gap down, and we've recouped that gap on the SP 500, and we're back above it. This little move people think is the end of the world. Meanwhile, you can see within a bull market, we can have much larger pullbacks along the way. So that's just how sensitive people are when it comes to the markets and news. And that's why Nvidia sold off so much, is because it's full of emotional traders. They're not true investors. They're just people piling in to buy it because everyone else has bought it and they feel like they need to have it. And so once they start to panic, they all sell it because everybody else is selling it. And it turns this news drop from last week. We were at all-time highs on the SP 500 the day before, and then we have a piece of news hit in one sector, and everybody thinks it's the end of the world. Like, that's how zoomed in people are to the news and way over analyzing stuff. I don't know if I answered your question or not, but
No. Yeah, that makes total sense. So in the event of like a significant downturn, so I mean, we could see from 2022. I mean, we had the invasion of Ukraine and
Yeah.
interest rates rising significantly, and there was also some issues with the Treasury general account, and I think they were issuing T-bills or something of that nature. But we did see some big downturns during those times. What assets like performed well during those times?
Which assets should have been held in 2022 type thing?
Yeah, yeah, in the downturn of the broader market, because you had mentioned like,
Yeah.
all stocks fall down, and you may want to be in some other trades.
Yeah. So a good example of that is if we zoom back to 2022, let me just get rid of some of this drawing here. 2022, I'll leave it where we're at. You can see here down at the bottom, 2022, we saw the US dollar. When the world gets nervous and starts to sell off, the US dollar had a huge rally. And we played the US dollar a little bit to the upside. That is, you if equities aren't in favor, there's usually a different asset that is. So the key is get out of stocks and move to, for example, this was a currency, the US dollar. Just holding US dollars, your account is going up in value. Well, if you're an international trader like I am, you want to hold a currency that's going up. And so just holding the dollar is a good play. You can also play UUP, which is a US dollar ETF. So if you're in the United States, you want to take advantage and juice it even more and actually see your account grow with a trade. You can play like a UUP or a USDU ETF. So this is a perfect example of like, okay, equities are now in a bear market based on the investment trend. Move out of stocks and then let's go somewhere else. And in this case, it's to hold a currency. And the nice thing about a currency is like, check this out. The biggest pullback during that whole rally was like just over 4%. That is pretty small compared to the stock market that moves like 30, 40% during that time. It was down 25%, I think. This ride, the nice thing about currencies is they're low volatility. And a big pullback isn't even devastating. So it's very easy to stomach and digest and ride out these trends. And that's what a lot of people don't understand. People don't believe in a cash position. They don't believe in just holding US dollar. They think it's too slow. It's even the same for the gold miner space. You look at gold right now, Daryl, and gold, it's hitting new all-time highs. And the crazy part is I've been like preaching on this, like, don't hold mining stocks. Like, they're not the play. Gold is the play, but nobody wants to play gold because it's slow and boring. They all want to get into miners to make more money. But that's not how things really work. You have to go where the money's going. And gold has been going sideways, and now we're making new all-time highs. If you take a look at silver miners, I mean, silver miners have been absolutely beaten. They're down. It fell 35%, still down 26%, all because people are trying to get more out of the markets. The key is to know where the money's going, get into that asset. If gold is too slow and makes you, and you're really bored because a big day on gold is like 1%, um, well, you can buy a 2x gold ETF. You can buy a 3x. Now it moves like a gold stock, but you have the accuracy and the control, and you're in the trend of something going up, right? You can even do put or call options. Or you could buy some shares and do cover calls on it because I believe it's still going to do well. So people just don't know. They naturally have to go to wherever the fastest, shiniest thing is. And it's such the wrong mindset. It's like, find the quality trade and then amplify the leverage to your quality, to the standard that meets. Sometimes you don't need to add leverage because it's a fast sector already or something, or you can jack it up. So
Yeah,
yeah, that's
yeah.
kind of my
What,
rant on that.
yeah, no, I appreciate that. So, if you can go back to UUP, UUP, this is like a trade you could do on the dollar. So, with thinking about this with this in mind, so I have for my cash position, I have in my accounts, I have Bill,
Yep.
the Treasury uh, Bill ETF. And so, obviously, Bill pays like I don't know what 4% dividend or whatnot. What things would you consider? So obviously, with a UUP, it's going to move up versus Bill
Yep.
is going to stay in the range,
Yep.
right? What do you think the difference there? Like, would you rather get the yield on holding Bill, or would you rather look at the move of UUP because you're going to get like a maybe a 5 to 7% move up or whatnot? What are your thoughts?
Yeah, so it'll come down to your risk tolerance. So this is the chart of Bill, as you said. It it kind of trades in this range, and the way that this works, because a lot of people don't understand how Bill works. The way it works is, say you buy Bill here, and what it's doing is it's adding the interest on your position every day. So the value goes up as you're earning daily interest. If you hold it past the end of the month, instead of having that share value keep going up, it just pays it all out in a dividend. So you get all this profit put into your account, and then boom, it starts again, and you start building interest again, and then boom, it'll pay you out your dividend, and you'll start going. So this is a like a pretty much a low to no risk strategy. You get in, you're going to make about 1/3% a month, which isn't much, but there's no downside. So it's nice and conservative. It's a great spot to park cash when there isn't a trade anywhere. UUP, which is a pretty ugly chart because it pays out these dividends. You can see that it breaks the chart up. There was another one back over here, a huge 4.5% dividend. So you see this big drop, but really you got injected a 4.5% dividend into your account, which is why I like to track the dollar index. But to answer your question, this is the dollar index because it gives us the clean view. I like if the US dollar is favorable, I would rather be in UUP, like the US dollar index ETF, because it has potential to run 1.5% to like 4 or 5% in a month. Maybe not that much in a month, but it can run 1% to 2% in a month, no problem. And so that's like 3, 4 times or more what you earn in bill. And so the key is if there is a quality setup in something that can make us more money, we want to go into it. So bill is great, but it's a no-brainer. There's no risk. You're not going to really become rich, but it's a spot to park your cash until something better like UUP or TLT, which is the bond fund, or the stock index. And we want to try and hold those more volatile assets when they're favorable because they give us more potential to make money.
Gotcha, gotcha. That makes total sense. Trades like TLT. I see that on the side. I was like, why not look at the bonds? Um, yeah, it looks like it's just still getting killed. What's your thought on the long term bonds like this, bond ETFs?
Yeah, the bond chart's definitely in a pretty bearish phase. I mean, it's been out of favor for a while. You know, there was kind of a blow off phase up here where it kind of topped out. We could even look at it here as a huge head and shoulders, and then it went into a stage 4 decline. I would say now it's more so like in a stage 1 basing formation. So it's trying to build a base. If we were to pull up this stage analysis, so you know, bonds put in this top in 2020, in 2021, it's gone through this, and now it's trying to build a base. And tops are difficult, which is why they're shaded red. And stage ones are red because they're difficult. There's a lot of wasted time. I know a lot of people have been picking bonds even back over here. They're like, I nailed that bottom. And then it comes up and then, you know, it makes lower lows. I mean, we're going on like 1, 2 years of not making any money, and you're at a loss. So that's the problem with trying to pick a bottom, especially when it's like a huge cycle to the downside, is you got to really wait for this tide to change directions. So I'll be excited when bonds like really start to break out above here or even over here. And you know, we've got some bullish price action where it's ready to start you know, another big move to the upside. So right now, yes, it might be darn close to a bottom. Maybe it did bottom, you know, over a year ago. But I would rather get into something once it's like pretty much when you get into it, it's just going to keep running up. I don't want to be in something trading sideways or down for 2 years, because if you can make 5.5 or 10 or 14% a year return, you know, you just missed out on, you know, 20 to 30% return over the past 2 years potentially, just because you wanted to try and pick a bottom and you know, be a superhero and think, you know, it's going to bottom. So if you scratch out your ego and be like, okay, I'll get into it when it tells me it's in an uptrend. I don't care if I buy it at a much higher price. I just want to get in, make the money, and then once that trade is over, go to a different asset. Could
Yeah.
be equities after that. So that's how I see it. Right now is dead money. It's a high risk play, and high risk play in terms of it still might be like 6, 8, 12 months before it actually breaks out and makes a move. So that's a lot of wasted time.
Yeah, yeah. Would there be so for confirmation, just from my looking at the charts, I mean, it looks like It struggled to break above 100 a couple of times. That looks like resistance. Um, I don't know if that 102, 100, 102. And then
Yeah.
it looks like 110, there was some resistance there. So for confirmation, would you be looking for a breakout above like 108, 110?
Yeah, I think as it starts to flatline and trade sideways, the momentum does shift. So ideally, I definitely want to see it above these highs, like this high over here. We want to see like an impulse wave where we see like a really nice strong move up, where we break two significant standout highs. And more or less, we'll probably start to see the long-term moving average, like 150-day moving average, which is kind of flatlining. We want to see it starting to slope up. So that means the overall trend should be moving up. We've broken two resistance levels. And then usually after that, the first pause and pullback can be bought. And then we'll probably see it, have multiple waves after that. So it'll be somewhere probably in this price range, above this 101, 102 level when I'll start to get excited. And that's when the momentum is shifted from down to sideways. And then it should be, upward trajectory.
Okay, got it, got it. And so looking at some of the indices, so with when we're looking at like the S&P, the SPY, we see the SPY is pretty much at all-time highs or whatnot. But then you have the equal weight index, SPY. I think it's RSP, um,
Yeah.
and that one isn't as elevated as the SPY.
Mhm.
So, what are your thoughts there? Because like for me, like I've been looking at okay, getting into more of the uh, like the SPY index or whatnot. But I mean, I mean, I could dollar cost average, at this time, but I mean, I'm dollar cost averaging into all-time highs and such, which, it's like, okay, I think there's going to be a better opportunity later down the line. And so, just want to get your thoughts on the equal weight index SPY, and then also when would you be looking to like enter some of these indices?
Yeah. So when we compare the two, the equal weighted SP 500 it isn't at all time highs, and uh, that's because it's got hit with tech, or sorry, this one hasn't got hit with tech in terms of the technology space has definitely lifted the markets, and it gives what I call camouflage. So if we look at the SP 500, we're hitting new all time highs, we're testing those levels. Whereas the equal weighted, which doesn't have all the weighting of the Magnificent Seven pulling it up, it's kind of underperforming. There's been a lot of selling going off in that space. So the market's not very strong. If you look at the volume, most of the high volume bars at the bottom are red. So there's distribution. In general, the stock market is still getting sold into. There are days of distribution, selling of big funds and portfolio managers lightening their loads and getting out. I believe we're kind of in this nosebleed territory. We have been for a long time. I think the stock market just needs some type of event that'll eventually take the wind out of the sails. I think this deep sea could be it because the Magnificent Seven might struggle a lot more. We're obviously getting through earnings season. We'll see how all that shakes out with the Magnificent Seven earnings and how investors go. But I mean, we're long the equities market from a long-term investment standpoint. We're long on a shorter-term standpoint. The technicals are still in an uptrend. I wouldn't say the markets are strong, but they're trending higher, and we want to be on board. And so, we're long the SP 500, we're long the Nasdaq, and I think we're going to see this have another push. I mean, we could do a quick Fibonacci on here to see where this upside move is based on this recent rally and the pullback. And that shows that we should see the market rally potentially from where we are as you and I are speaking. The SP 500 up about 3.5% to the upside. It's not huge, but it is a pretty nice move. And that's going to be the first area where things kind of run out of steam. The NASDAQ
Hmm.
have probably a bit different of a scenario. It's been a little bit more volatile, but if we were to do the same thing, let's just see where that is percentage wise. We could see it run 2.5%. And NASDAQ's losing some of its power. The SP 500 is starting to look more powerful again. We actually saw the SP 500 outperforming the NASDAQ back in this phase over here. It was actually doing very well. And that was a red flag. If the SP 500 is outperforming, usually we're going to see a pullback. And then we've seen like a multi-month pullback, and the markets are still digesting all of this. So if we see the SP 500 outperform, that'll be another red flag that maybe the next bout of selling will be bigger. And it just shows that the market is slowly weakening.
Got it. And then as we get ready to close out, I wanted to get your view on Bitcoin.
Sure. Yeah. So if we take a look at Bitcoin, we had a really nice trade in Bitcoin recently. We got into Bitcoin over here. We hit our first target. We hit a 40% target right up here at 108,700. Literally got out right near the peak. That was a Fibonacci measured move. And now the market's digested. It actually has a really nice bullish chart pattern here. It looks like it wants to go higher. If we look at the Fibonacci levels, we can see there's potential for Bitcoin to run from where it is right now up about 10% from where it is. So there's pretty nice pattern set up there. This is a nice bull flag pattern. It's picking up speed. So we're actually long Bitcoin in one of our strategies and taking advantage of this. I think we're going to see another push and squeeze to the upside. So I like Bitcoin here. It's a pretty nice looking chart setup, and it's kind of a mass psychology play. I think once it starts to break out again, people are going to pile in, and it's going to have a huge pop and surge. And it's a short-term trade for me. I don't hold Bitcoin as any type of long-term investment. It's like get in, play the trade, get out, wait for a fresh new setup.
Got it. Yep. Well, thanks for sharing that. Well, Chris, man, lots of valuable information there, especially with the charts. Where can people find more about you, about your asset revesting strategy and such? Plug the people.
Sure. Yeah. Well, if you guys want, you can go to YouTube, just type in The Technical Traders. You'll see my channel show up, or you can go to thetechnicaltraders.com and join my free newsletter. I share all kinds of insight and analysis and on the markets pretty much every week. And follow along. And if you want, you can copy the trades that I do with my own portfolio. And it's pretty straightforward. I just trade ETFs. We rotate from one asset class to another. And there's about 5 to 12 trades a year. So it makes it pretty easy to follow.
Yep. All right. You all be sure to go check it out. Just know that Chris has his views. I've seen some people in the comments say, oh, he's been calling for a recession for a long time. We trade with the charts, not our hearts. You know what I'm saying? So the charts are going to tell you what's happening or whatnot, even though we may have our own biases or our own views of okay, this is getting kind of toppy, but the charts is going to tell us what's going to happen. And so I always appreciate looking at the objectiveness of the technical charts.
For sure.
Yep. All right. Take care.
All right. Thanks. Bye-bye.